Now, of course, lots of earnings reports flooding the market today. I want to get to two big ones, oil giants, ExxonMobile and Chevron, a disaster area there in terms of earnings after the price of crude plunged in the quarter. Let's get the latest now from Emily McCormick. Good morning, Emily.
Good morning, Alexis. And we are looking at the price of West Texas Intermediate crude oil prices rebounding a bit today after a tough April. We have those futures up about 6.5% in early trading this after an about 8% decline throughout the month of April. And do want to point out that today is May 1st. So starting today, members of OPEC Plus will be cutting output by a collective 9.7 million barrels per day through the end of June, the single largest output cut in history. Well, that's just about 10% of overall global supply, potentially something that could help support oil prices that have been under pressure. Now, looking at these earnings results we got this morning, more misery for the oil major companies at least. We had ExxonMobil unexpectedly posting its first quarterly loss in at least 32 years to the tune of $610 million. That was driven by a $2.9 billion non-cash charge from write-downs during the quarter. And for comparison, the company posted income of $2.4 billion in the same quarter a year ago. So a steep reversal there. The company did say at least it is sticking to its previously announced plan to cut capital expenditures by $10 billion to a total of $23 billion for the year. That's unlike some of these other oil companies that we've seen who've come back out and recently announced deeper cuts with the crude oil slump we saw in April, including Chevron. And we do have ExxonMobil as the world's largest oil explorer, and their CEO, Darren Woods, said in a statement today, quote, COVID-19 has significantly impacted near-term demand, resulting in oversupplied markets and unprecedented pressure on commodity prices and margins. While we manage through these challenging times, we are not losing sight of the long-term fundamentals that drive our business. So they are at least putting out a bit of an upbeat note there. Then turning to Chevron, we did see a profit from them for the first quarter, but they were one of the oil companies that did cut its capital expenditure plans another time since that oil plunge last month. This time by $2 billion to as low as $14 billion for the year overall. Now, originally that company had planned $20 billion in capex for the year, so a reduction from that level. These reductions are mostly going to hit Chevron's shale productions, with activity in both the Permian Basin and Canada getting slashed. They're also going to be paring back some of their refining operations. And the last thing I want to note is that Chevron outlined weakening demand in a slide presentation this morning. They talked about jet fuel demand being down about 75% during the quarter and diesel down about 25%. So that really illustrates just that demand destruction that we've had during the coronavirus pandemic. We do have stocks for these companies down each about 1% in early trading. They are down pretty steeply by double-digit percentages for the year. So just extending weakness there for the oil majors. Alexis?